Hey everyone, welcome to the KE Report in a daily editorial with Craig Hemke. Craig is the founder and editor of TF Metals Report. As we always do with Craig, we'll talk about what's going on in the precious metals sector, and price level wise, pretty impressive prices. Gold is over $3,000 an ounce. Silver continues to perform pretty well. That is over $34 an ounce, closing in on $35. Even the stocks, GDX is very close to breaking to levels not seen since around 2012. So a lot of positive things happening on the gold front. But Craig, I want to start off with an ongoing story, something that we have talked about in terms of the gold that's held by the US and this potential revaluation we could be seeing. One thing you pointing us to is this Bitcoin strategic reserve, a recent bill that looks like it's going to go in front of Congress, outlines what the strategy is for the US in terms of building up a Bitcoin reserve. And where I want to start is how they're going to fund it, because it's actually mentioned in there that they are looking at revaluing their gold that they already hold, issuing notes on the back of this new value to then buy Bitcoin, planning on buying a total of 1 million Bitcoins, about 200,000 Bitcoins a year over 5 years. Craig, what do you think of this whole concept here? Revaluing the gold that the Fed holds to then go out and buy Bitcoin.
Yeah, hi guys. So many interesting things going on, especially if you could just go back to December, really. After Trump was elected is when we started seeing all these dislocations between spot and futures, and all the metal leaving London, going to Switzerland, or going, directly to the US, whatever. And all of that continues to this day. Yeah, this notion of the strategic Bitcoin reserve that Trump, I think, first started talking about, it seemed like he was almost pandering for votes last summer. But it's something he's pursued. And about a week or two ago, he actually signed an executive order saying we want to go out and do this. There's a lot of talk that they would just use some of the confiscated, like, what is that, Mount Gox or whatever that was called, failed exchanges, things like this, things that they've grabbed over the years as part of, just hold that Bitcoin. But then there's also a lot of thought that maybe the government start accumulating some. I would direct everybody first back to the comments made on February the 3rd in the Oval Office, where Trump was signing another executive order saying he wanted to create a sovereign wealth fund. And somebody asked a question about how you're going to fund this thing. And he says, hey, well, my friend Scott over here, the Secretary of the Treasury, has got some novel ideas as to how we're going to do this. And that's when Besson said, yeah, we're going to look at monetizing the asset side of the balance sheet. And that left everybody kind of scratching their heads, because other than land and some office buildings, there are not a lot of assets on the U.S. balance sheet other than gold. So that kind of led to a lot of speculation. Okay, so anyway, over the weekend, I had a guy from my site email me a link, say, hey, have you seen this? And I don't see anybody talking about this yet. And what that link contained was some news from last week that if you go back to the previous Congress before this most recent election, the 118th Congress, a senator from Wyoming and a congressman each introduced bills in the separate chambers of Congress, creating a strategic Bitcoin reserve. Now, Trump, I don't know if he can do this by executive order or not, but you would think he'd want to kind of legally codify it. And so this is how it would get done. People my age will remember, the old Schoolhouse Rock of I'm just a bill, I'm only a bill, and I'm sitting here on Capitol Hill. Well, these are bills that have to be voted on, run through committee, reconciled into one, and then for it to be actually codified into law or as a statute, the president has to sign it. Well, for now, they're just bills. It was, like I said, originally introduced in the last Congress, but then reintroduced last week. So I'd invite everybody. I've got the links on my Twitter page. Maybe you guys can put a link to this thing. You can read the bill. I mean, it's right in the ussenate.gov, website. You can read all of that. It tells you about how they're going to do it, how they're going to fund it, how they're going to store the Bitcoin, how they're going to purchase the Bitcoin, all this kind of stuff. Now, maybe this isn't exactly how they'll do it, but this is the bill that's in Congress called the Bitcoin Act of 2025. Anyway, all the way down, scroll all the way down, they say the funding of this, how are they going to get the money to buy this 1 million Bitcoin? Well, they're going to revalue the gold. that the U.S. carries on its balance sheet from the current law, or what was again codified all those years ago at $42.22. They're going to run it back up market to market. That increases the asset side of the balance sheet, and against that they'll issue new debt and take the proceeds of that debt offering and use that cash to buy the Bitcoin. Apparently, net, you have the same net liability. You get assets went up by, let's say, $1 trillion, and the liability side went up by $1 trillion. Net, no change. What this would do to the gold price, I don't know. I mean, we've never lived through this before. If anything, it's just more funny money creation. It's an accounting gimmick to allow them to create another $1 trillion and flush it out into the world. That's always been pretty positive for the precious metals. And so after that long answer trying to provide a brief summary, I think that's what we've arrived at. If anything, it's just more QE, it's more fiat money devaluation that would come with a gold revaluation.
Craig, what a wild world we are living in, where gold is going to be revalued. The fact that it was only valued at $42 is insane to begin with, but the fact that they're going to revalue it, then create these gold certificates so that they can issue magical new funny money, monopoly money from the government, from the treasury, to be able to buy Bitcoin, which is a digital currency, and the government's going to be the hodler. They're not just going to hold it, they're going to hodl it, Craig. So what a wild world, but it also shows you that there is still value to the yellow metal, and that's evidenced by the price breakout that we've seen really the last 2 years, but especially this year, up over $3,000. Let's talk a little bit about silver, though. Silver is also having a little bit of action, and not just action on the price charts, physical action, where there's physical silver for delivery, there's silver moving around. So there's gold and silver being repatriated, and there's silver moving around on some of the exchanges and some of the holding the vaults. So what do you make of the movement of the precious metals from one country to another, from one vault to another?
Isn't it crazy? I mean, we've been told, the mainstream explanation, I should say at least, is, it's preparation for tariffs. If tariffs are put on in Canada and Mexico, we got to get this metal back here while we can. I've not seen any notion or any mention that there are going to be tariffs on gold and silver. In fact, I've seen some analysis that you really can't tariff gold because it's money. It's not an actual product. Okay, whatever, but that's the mainstream explanation. And what we've seen, again, going back to December, is this dislocation between spot and futures that is not, or at least it has kind of now been closed over the last couple of weeks through arbitrage, but that has been eye-opening for a lot of folks. We've seen all this metal either officially reported 400 tons. The people at the StoneX Group, which is one of the largest commodity and financial firms in the world, saying it's more like 2,000 tons have come into the U.S. The official data, showing London gold being drawn down, having to go to Switzerland exporting a couple hundred tons to the U.S., all this stuff. Well, and then we saw these massive deliveries on COMEX. January, which is not a delivery month, not a front month, February is, but January saw 22,000 some odd deliveries, which is an extraordinary number. I mean, 10 times what it normally might be of 2,000 contracts. Then we get into February. It did something like 77,000 delivered, 7.7 million ounces, the most ever done. Again, delivered with, air quotes around it, off of COMEX. The pace is continuing briskly. It looks like they might do 20,000 here in March. Well, then that's spilling over to silver as well. We had a huge rush in February silver. March for silver is delivery month. Looks like it's on pace to be the largest silver deliveries ever seen, maybe 80, 90 million ounces, 18,000 contracts, 17,000 contracts by the time we're done. And now we're seeing extraordinary amounts of silver being deposited into the COMEX silver vaults every day. There's 9 of them. And everything, you get these reports every day from the CME group. It's one day delayed. You get a report on Wednesday. It's for the vault activity on Tuesday, okay? And at the bottom of all of these reports that you can download is a disclaimer that the CME added, 7 or 8 years ago, that says the information in this report is taken from sources believed to be reliable. However, the CME disclaims all liability whatsoever with regard to its accuracy or completeness. So even the people that issue the report aren't necessarily standing behind it, but it's all we've got. Well, We're recording this here on Monday, March the 17th. We haven't gotten the Monday report yet for the activity back on Friday. But we do have all the activity Monday through Thursday of last week. Just Monday to Thursday of last week. Those 4 days saw 15.34 million ounces of silver be deposited amongst the silver vaults. I mean, we're only really about 4 or 5 on the COMEX. 15 point, now, does that sound like that's 477 metric tons of silver being brought in and deposited in these various vaulting, they're all within about 20 or 30 miles of New York City. So the way you want to, think of this, a semi truck can carry about, let's call it 20 metric tons. So think about, 20, 25 semis driving around the tri-state area, dropping off, these pallets of 1,000-ounce silver bars for deposit at Brinks and at Asahi and at JP Morgan and the rest. Okay, that's unprecedented. But furthermore, where's it coming from? I mean, we're not seeing metal leave yet. That's the next thing we want to watch for. But they're reporting all these deposits. From where are they getting it? Is it all coming in on ships into the port of Newark? I have no idea. I mean, I'm asking these questions rhetorically. But anyway, just another crazy data point in what has so far been a real crazy start to the year.
So, Craig, considering all this metals movement and also considering the prices that we're seeing in terms of US dollar prices for these metals, do you think that we can say Western demand is back? There is a component here, Western demand, that is truly helping to drive the precious metals higher.
I don't know. I mean, the traditional ways we'd measure something like that is reaching out to bullion dealers to see if, what kind of their demand levels are. Heck, as recently as a couple of weeks ago, I was talking to people at APMEX and SD Bullion. They're like, we've been dealing with a lot of buybacks. We have people selling back to us more than we have people buying. That they both indicated kind of changed in the last 2 or 3 weeks. But so I don't know. You look at ETFs, and are people buying ETFs? I don't know if that's really the case either. So I've never really been sure how to really get a handle on Western demand. And it's like all this metal going into the COMEX. I mean, they deposit 477 metric tons. Okay. But if that's just going to be used to kind of de-lever the place or to shuffle warrants around and delivery receipts every time there's a delivery month, well, what's the big deal? I mean, now if all of a sudden, we track these things every day and the received category goes to 0, but the withdrawn category suddenly is 477 metric tons. Well, then maybe we'll be on to something. But for now, it's just all this metal that's suddenly flowing into the U.S., both gold and silver. And we're all kind of left, trying to connect dots to try to figure out if there's anything substantial going on in the background. And we just don't know yet.
Well, it is definitely a wild environment. And yeah, if they become withdrawals where people are actually having the physical silver, where they're actually not just standing for delivery, but actually taking delivery, it's going to be interesting to see where the silver is coming from and where it's going to. But this also highlights, and I think shines a light on the precious metal sector as a store of value for the metals. But then look at the mining stocks, Craig. They've actually responded because guess what? They just had a great Q4. They've been pulling metal out of the ground at the fattest margins for gold that we have ever seen. And silver, not quite as fat, but still good margins for them. But now look at Q1. I mean, we're 2/3 of the way through, more than 2/3 of the way through Q1 now. And these are even a higher average price for the quarter than we had in Q4. So how do you think all of this passion for the metals is going to affect the mining stocks that are pulling it out of the ground?
Yeah, that's I think the fact that the shares pulled back immediately after earnings season was done, but then now have turned around, and the GDX, if we use that as a proxy, is trading at levels not seen since 2020. The close last Friday, the 14th, the GDX closed at 43.64. On the weekly chart, that's the highest weekly close since Friday, January the 18th of 2013. I mean, that gives me joy and sadness to point that out, that it's been freaking 12 years since we've had a weekly close of the GDX as high as we had last Friday. So the fact that we got kind of the typical pullback, it's like, okay, sell the news, and now this mining money is dead money again until we get a better handle on what the next quarter is going to look like. Instead, that we've turned right around and we're making, again, some of the highest trades we've seen in 4.5 years. That's a good sign. And at the end of the day, I think it's signaling to us that maybe a little more institutional money and long-term traders and the like are starting to pay attention to the sector, because why would they be moving up now? Well, somebody is, if you look at it and you think, okay, the Newmont, for example, you guys know how I feel about them, but we'll use them as an example. Their average sale price in the fourth quarter was about $26.50 an ounce. Okay. The average price for gold here in this first quarter is north of 2,800. So that's another, what is that, 5 or 6, maybe 7% higher than it was in the fourth quarter. We've seen energy prices come down, so you would think margins would not just go up by 7%, they might go up by 10. And so people are, if you're thinking about the mining sector, that leads you to do this math and begin to anticipate the next quarterly earnings rather than wait all the way to the end and think, oh, I'll buy some because maybe the earnings will be good, better tomorrow. That kind of thing. So the fact that the shares are moving up now, I think, is a good sign for that kind of generalist, institutionalist investor that whoever that is, that we keep hoping is going to start paying more attention to the sector.
So, Craig, let's face it, a lot is going in favor of the precious metals right now when you look geopolitically. Even when you look market sense-wise, investors are going defensive. The momentum is clearly on the side of the precious metals, and quite frankly, the world is at war. It's a trade war right now. Everybody is going against the U.S., and there's a whole lot of uncertainty out there. This is all playing into, obviously, this defensive nature of investors. But we do also have to consider what central banks are going to do. And this week, we do have a Fed meeting. A lot of other central banks around the world, outside of Japan, really seem to be looking at rate cuts, but also pumping the brakes a little bit on those rate cuts. The Fed being no different. This meeting's going to be interesting again because it's a quarterly meeting. It's happening in March. We will get updated dot plots, which outline where the Fed officials see rates going. It seems like a lot of attention is left what the Fed's doing because of these trade wars and geopolitics, but it is a Fed meeting, Craig. So what are you expecting? What do you think matters for the markets?
Well, it is going to move things. Again, it'll be Wednesday afternoon, 2 o'clock Eastern. You'll get the what I call the Fed lines, their summary of what they discussed. But you'll also, because it's on a quarter, March, June, September, and December, you'll get a summary of economic projections, which includes that dot plot you mentioned, Corey. Back in September, the Fed cut, remember, 50 basis points, or I think that was at the September meeting, and they increased their projection for rate cuts this year to 4. Well, by December, and the most recent SEP, Summer of Economic Projections, they cut this year back to 2. Well, what has happened since? A lot of slowing economic indicators. Heck, we've seen what the Atlanta Fed has done for the GDP model for the first quarter. And I've watched, there's a CME market tool that projects rate cut likelihood. Just a month ago, you had to go all the way out to September before you got a 50-50 chance of a rate cut. Now it's better than 50-50 that we'll get one in May. So the summary of economic projections is going to bump up the rate cuts again this year from 2 to maybe 3. Maybe they'll add one next year. I think the other thing we'll watch for is whether the Fed announces an end to their quantitative tightening program. They cut back how much it was that they were buying back a couple of months ago. We'll see if they announce that they're going to be ending that. So people will pay attention Wednesday. Not only those Fed lines, but to Powell's press conference at 2:30. It will move the markets. It'll move the dollar index. It'll move the bond market, and then by extension, the computers will move gold and silver too. So that'll be a big event, and we'll kind of lay the groundwork and foundation, hopefully, for more gains in the metals as we move into the second quarter.
Craig, just one more point to make today is that it's St. Patrick's Day, and gold is breaking out above 3,000 on the futures market, and it's one of the best days in gold history ever on planet Earth. Is it possible that the leprechauns are involved because the Irish love their gold and so do the leprechauns, Is it interesting that this is happening on St. Patrick's Day?
That's a great point, Shad. Makes me want to go pour myself a glass of Jameson and wash it down with a Guinness to celebrate. I did say that last week when we finally got the futures price of gold up over 3,000 on Thursday. I told everybody in my Twitter feed, I said, man, you know what? Take a moment here and enjoy this. Savor this, because it's been a long fight. I mean, it wasn't that long ago. We were below 2,000. It wasn't really that long ago. We were barely above 1,000. And I'll give, maybe this would be a good point to wrap up on this one I made on my podcast to TFMR members over the weekend. If you pull up a weekly chart of spot or whatever, down in the lower left-hand corner 5 years ago, exactly 5 years ago, gold was $1,500. We're now here at $3,000 5 years later. And there's a lot of people saying, oh, that's as far as it's going to go. I'm going to wait for the next pullback and that kind of thing. I think it should pull back to 2,000 because 3,000 is too expensive. Okay, well, to go from 1,500 to 3,000 in 5 years, to double in 5 years by that old rule of 72, you just have to compound at about 14% to double in 5 years. Okay, since the turn of the century 25 years ago, gold compounded return is about 10%. So if we just keep clipping along here because they're devaluing the currency and printing money and, trying to keep the plate spinning for the next 5 years, we just keep clipping along at 14% instead of 10, we're going to double this price again in 5 years. And so just like from 2020 to today, we've gone from 1,500 to 3,000. That implies 3,000 to 6,000, regardless of the pricing scheme and all this metal flowing around and hypothecation and all the other stuff we talk about. Just simple math means, the idea, we're at 3,000, that's fun, but by no means, given the economic breakdown and what we've always called the end of the great Keynesian experiment, do I think price is done. I think we're going to keep going higher, and it's not going to take a whole lot over the next handful of years to see us move up through 4,000 and 5,000 and beyond.
Oh, I know a lot of investors in this space are also wondering, how long is this bull market going to last for? Depends where you choose it from. It really started breaking out last year, just over a year ago at the very beginning of March. But look, a bottom was made almost 10 years ago now. So this price has been moving, and it's just nice to see the shares continue to pick up the slack here. The higher quality companies are doing very well, and we're seeing more and more companies join into this rally. Hey, so far, as I said, pretty much everything seems to be going in the favor of the precious metals. Craig, great chatting with you as always. Again, Craig is the founder and editor of TF Metals Report. Click that link in the show notes to follow along with Craig. Craig, thanks for your time today.
All the best, guys. Have a great week.